In this video, we're going to review the 10 steps of our accounting cycle, beginning with identifying and recording in a general journal transactions, posting transactions to the general ledger, preparing a trial balance, then preparing adjusting journal entries and an adjusted trial balance prior to preparing our financial statements. After preparing our financial statements, we'll go through the closing process and preparing a post-closing trial balance, which prepares us for the next accounting period. We will not in this exercise discuss reversing entries. We're going to begin with journalizing business transactions. The Financial Accounting Standards Board defines transactions and other events and circumstances that affect a business enterprise. There are two primary types of transactions: external transactions between a business and its operating environment, and then internal transactions, events that occur entirely within a business. We need to record both types of transactions. The external transactions are those that we will consider first, then the internal events we'll consider as part of our adjusting process. In this exercise, we're going to consider the journal entries or transactions for the Northeast Welding Company that occurred during 2004. Our first transaction, Northeast Welding, started operations by issuing $68,000 in common stock in exchange for cash. The first thing we do before we record our transactions is to evaluate how it impacts our extended accounting equation. In this case, issuing common stock causes an increase in equity, and the cash we receive is an increase in cash. The $68,000 increase in cash and asset is recorded with a debit, and the $68,000 increase in common stock and equity account is recorded with a credit. This transaction doesn't involve revenues or expenses, so it doesn't have any impact or change on the profit margin. Our second transaction involves the purchase of equipment for $48,000 in cash. This causes both an increase and a decrease in assets. Cash goes down by $48,000 and equipment goes up by $48,000. So our journal entry includes a debit to equipment for $48,000 to reflect the increase in assets, and a credit to cash to reflect the decrease in assets. Once again, since there's no impact on revenues or expenses, we would say this transaction does not impact or cause our profit margin to change. The third transaction, we pay $3,000 in cash in advance for rent for the period from February 1, 2004 to February 1, 2005. Since we're paying cash for rent in advance, we will record this as a decrease in cash and an increase in another asset, prepaid rent. And we can see the impact on our accounting equation. Let's go ahead and record the transaction. We'll have an increase in prepaid rent in the amount of $3,000, which is recorded with a debit to assets, and the decrease in cash and asset is recorded with a credit of $3,000. And again, since this does not involve revenues or expenses, there's no impact or change on our profit margin. Our fourth transaction, we received $2,400 in cash in advance for services to be performed evenly over the period September 1, 2004 to September 1, 2005. We've received cash, which is an increase in assets. Since we have not yet performed a service, we have an increase in liabilities. This is unearned revenues. This is much like how Millersville University would record your payment of tuition prior to the beginning of the semester. As we perform our service, we will decrease the liability and record a revenue. In terms of our journal entry, the increase in cash is a debit for $2,400, and the increase in unearned revenues is a liability, and we record liabilities with a credit. Increases in liabilities with a credit. Once again, there's no change to revenues or expenses, so there's no impact on our accounting equation, or no impact rather on profit margin. In transaction 5, we perform services for customers on the account for $38,500. Since we've performed services, we have a revenue, and on account means we've had an increase in accounts receivable. So we have an increase in assets, which will be a debit, and an increase in revenues, which we will record with a credit. So we have a debit to accounts receivable for $38,500, and we have a credit to service revenue for $38,500. The increase in revenues will ultimately lead to an increase in net income. And since net income is increasing, this will cause an increase to our profit margin. In transaction number 6, we incurred operating expenses on account, which means accounts payable, in the amount of $17,000. This is an increase in liabilities and an increase in expenses. We record increases in expenses with a debit. So we have a debit to operating expenses for $17,000, and we will have a credit to accounts payable for $17,000. Since our expenses will cause a decrease in net income, we would say the impact of this transaction on our profit margin will be to decrease the profit margin. In transaction 7, we collect $32,500 in cash from accounts receivable. So we have an increase in cash of $32,500, which is recorded with a debit, and we'll have a decrease in accounts receivable for $32,500. Since this transaction doesn't involve revenues or expenses, there's no impact on our net income and no impact on our profit margin. In transaction 8, we pay $12,000 in cash for salaries expense. So cash will decrease and we'll have an increase in salaries expense. The increase in salaries expense is recorded with a debit to salaries expense in the amount of $12,000 and a credit to cash in the amount of $12,000. Since this transaction involves an expense and increases in expense will cause net income to decrease, we'll say that this transaction's impact on the profit margin would cause it to decrease. In transaction 9, we pay $14,500 in cash, so we have a decrease in assets, as a partial payment on accounts payable. So in addition to a decrease in cash, we have an equal decrease in liabilities. The decrease in liabilities is recorded with a $14,500 debit to accounts payable. And then, of course, the decrease in cash is a $14,500 credit to cash. The transaction does not involve a revenue or expense, so there's no impact on our net income nor any impact on our profit margin. Thus far, we've considered only external transactions between a business and its external environment. Before considering internal events, we will go ahead and post these journal entries to the general ledger, which is the second step in our accounting cycle. Since this is our first year in business, the beginning balance in our trial balance or T accounts and ledger accounts is 0 for all of our accounts. Let's begin with transaction 1. It was a $68,000 increase to cash, which is a debit, and a credit to common stock in the amount of $68,000. The second transaction involved an increase to the equipment account of $48,000 and a decrease to cash for $48,000. So we have a credit to cash and a debit to the equipment account. Notice the transaction numbers here. This would be our cross-reference to the general journal. The first transaction, cash, would have been transaction number 1 in our general journal. The second transaction in our ledger account for cash would be transaction 2. This cross-reference is important because if we were to look at transactions that occur in the cash account in terms of looking at the general ledger, looking at the $68,000, we don't know how that $68,000 was raised or how the $48,000 was spent until we look at the cross-reference over back to the general journal. let's go ahead and finish posting our journal entries to the T accounts. Number 3, we had an increase in prepaid rent of $3,000, and that was a decrease in cash of $3,000. The fourth journal entry was an increase in cash of $2,400 and an increase in liabilities unearned revenue of $2,400. The fifth transaction was an increase in accounts receivable of $38,500 and a credit or increase to service revenue of $38,500. Transaction 6 was an increase to operating expenses in the amount of $17,000, and it was a credit to accounts payable. So transaction 8 was an increase in cash of $12,000 and an increase in salaries, or rather a decrease in cash of $12,000 and an increase in salaries expense of $12,000. The final transaction was a decrease in cash for $14,500 and a decrease in accounts payable for $14,500. After posting journal entries to the general ledger, the next step is to prepare a trial balance. Our trial balance is simply a sequential listing of all of our accounts with their balances designated as either a debit or a credit balance. Let's go ahead and take a look at our trial balance. Here's our trial balance for Northeast Welding on December 31st, 2004. Notice we've got $25,400 in cash, $6,000 in accounts receivable, $3,000 in prepaid rent, $48,000 in equipment, $2,500 in accounts payable, $2,400 in unearned revenue, $68,000 in common stock, $17,000 in operating expenses, $12,000 in salaries expenses, and of course $38,500 in service revenue. Now that we've recorded the external transactions for Northeast Welding during the period and have prepared a trial balance, we can consider the adjusting entries that are required prior to preparing financial statements. We have 4 adjusting entries that we're going to consider for Northeast Welding. The first transaction is to record the adjusting entry for the expired rent, see Event 3. We paid $3,000 in cash advance for rent for the period February 1, 2004 to February 1, 2005. So we paid $3,000 in rent for a 12-month period, or $250 per month. During the year, 11 months have expired, February through December, at $250 a month. So we should have $272,750 in rent expense, or we can think about having 1 month left of unexpired or 1 month of prepaid rent in the amount of $250. Let's go ahead now and take a look at our T accounts for both prepaid rent and rent expense. In looking at our T accounts, we can see our rent expense for the year currently is 0, and yet the balance should be $2,750. And the balance in prepaid rent is $3,000, and we can see the balance should be $250. We can take one of 2 approaches to this. We can go at it from a balance sheet approach and say, what should the balance be in prepaid rent? $250, which means we need a $2,750 credit to prepaid rent. And of course, then the debit would be to rent expense. And both those entries would give us the correct balances for prepaid rent and rent expense. Or we could take an income statement approach and say, let's get the income statement right. we need a balance of $2,750. Currently the balance is zero. Obviously we need a debit for $2,750, and we would have to credit another account, which would be the prepaid rent for $2,750. Either approach will give us the same adjusting entry, a debit to rent expense for $2,750 and a credit to prepaid rent, and the proper ending balance for prepaid rent and the proper expense for 2004 rent expense. And of course, since this journal entry involves a decrease to assets and an increase to expenses, the increase in expenses would decrease net income, and we would say this adjusting entry will serve to decrease our profit margin. Our next adjusting entry, number 11, is we recognize revenue for the services performed in accordance with event number 4. In event number 4, we received $2,400 in cash advance for services to be performed evenly over the period from September 1, 2004 to September 1, 2005. If we take that $2,400 and divide it by 12 months, that's $200 per month. And since we received revenues for 4 months, September, October, November, and December, we have $800 in service revenue, and 8 months, or 8 times 200, $1,600 we should have in unearned service revenue. Let's go ahead again and take a look at our T accounts. In looking at the T accounts for both unearned revenue and service revenue, we can illustrate why it's often easier in terms of adjusting entries to take a balance sheet approach. Our service revenue account, we said from this contract, should be $800. And we know that since we only had one other transaction, we have not recorded this revenue. But during the course of a year, we probably have quite a bit of different revenue transactions, and it's more difficult to look at that ending balance to revenue and know whether all of our revenues have been recorded. It's easier typically to look at a balance for unearned revenue. And in this case, we know our unearned revenue should have a balance of $1,600 instead of $2,400. So if our balance is $1,600, we know that we need an adjusting entry in the amount of an $800 decrease or debit to unearned revenue, which of course would be accompanied by an $800 credit to service revenue, which is how much additional revenue we saw we should book for the months of September, October, November, and December. So our journal entry then is an $800 debit to unearned revenue and an $800 credit to service revenue. So our liabilities have decreased. We have an increase in revenues. The increase of revenues, of course, will increase our net income, which will have an increase in our overall profit margin. Our next transaction involves recording $1,600 of accrued salaries at the end of 2004. This will be an increase in liabilities and recording of a $1,600 expense. Since the expense decreases net income, we would say the impact on our profit margin, of course, is a overall decrease. Finally, transaction 13, we record depreciation on our equipment that was placed in service on February 1. This is a 4-year estimated life and no salvage value, and the company uses straight line depreciation. So our $48,000 cost minus salvage of 0 means $48,000 divided by 4 years or 48 months is $1,000 per month. We had our equipment in service for 11 months during the year, February 1 through December 31st, so we'll record $11,000 in depreciation expense. This transaction involves a decrease in assets, that's our credit to accumulated depreciation, an increase in expenses, that's our debit to depreciation expense. The increase in expenses, of course, decreases net income, so the impact on our profit margin overall is a decrease in our profit margin. In terms of our accounting cycle, after recording our adjustments, which again are internal events or events occurring entirely within our business, we will post the transactions to our general ledger and then prepare an adjusted trial balance. and we will use our adjusted trial balance to prepare financial statements.